Alright guys, welcome back to another video. This week was probably one of those weeks where if you were just staring at the charts, the moves probably didn't make much sense to you, especially today being Friday where the markets had this massive sell-off. So instead of overcomplicating things with a million data points, I want to walk you through exactly what happened this week, what moved the markets, specifically what happened behind stocks like Broadcom, Oracle, why the Nasdaq got hit the hardest, and why gold didn't really care at all. And once you understand that story, the price action will start to make more sense. So I wanted to make this video more for the purpose of trying to show you guys how you can frame stuff going on in the world, how that affects indices and gold or whatever asset you're trading, and translate that into your strategy, whether that's, scaling into a position you like, scaling out a position maybe that you're in, or looking for a new setup altogether. Because stuff like this with a macro bias gives you the cleanest entries for positions and just positions yourself properly for these types of trades. So let's start with the backdrop because this is important, but it's not really the main story. So on Wednesday, we had FOMC and the Fed cut rates this week. That immediately did a couple things. It puts pressure on the dollar, it pushes yields lower, and that does support gold, which initially would support stocks. So early in the week, the market treated this as more of a soft landing cut, not really panic, not recession indicating, just easing because growth is slowing. So coming into the week, the narrative was pretty simple. Lower rates equals a more supportive environment. And this is why early in the week, everything still looked pretty constructive, especially with all the red folders that we had coming into the week. So speaking more on that, we also had stuff like ADP, JOLTS, employment cost index, and unemployment claims. And the key takeaway from all this was pretty consistent. The labor market is cooling, but it's not breaking. Wage pressure is contained and inflation isn't accelerating. So this gives the Fed cover to cut and it keeps the soft landing narrative alive. But the key point here is none of that data caused this massive Friday sell-off. It set the stage, but it wasn't exactly the trigger. So coming into Friday being today, Friday wasn't really about the economy collapsing. It's more about the stocks behind it, specifically the AI stocks. And this was just these AI stocks running into their reality. And the first big name that actually cracked was Broadcom. Broadcom sold off really hard today with about 11%, and that immediately sent a message through the market. Why? Because Broadcom isn't just a stock, it is a core piece of the AI infrastructure trade. When a name like Broadcom drops very sharply like this, the market isn't saying AI is dead, but it is saying, wait a second, are these valuations justified right now? Concerns started popping up around margins, sustainability of AI demand, and whether earnings can actually catch up to this hype with AI. And this was the first crack. And then Oracle came in and basically confirmed the same thing. Oracle had already been weak earlier in the week, and the concerns were very similar. Heavy data center spending, massive AI capex, questions marked around how quickly can that spending actually turn into profit. So now you have two major AI linked names sending the same message. AI is expensive, and the returns aren't immediate. And at this point, this stopped being one stock and became more of a theme here. So jumping back onto the charts, why did the Nasdaq absolutely get slammed? The Nasdaq is obviously extremely concentrated in AI, mega cap tech, and high valuation growth stocks. So when Broadcom sells off, Oracle confirms this weakness, and the yield ticks up a bit, the Nasdaq will bleed very quickly. And this isn't panic selling, this is just de-risking and a valuation reset. On the other hand though, the S&P 500 got pulled a lot lower too from the highs that we were making previously in the week, but notice how it held up a lot better than the Nasdaq. This is just because it's more diversified. Financials, energy, industrial, defensive names. So this wasn't really a sell everything moment, but it was very clearly an issue with tech, which means the Nasdaq is going to take the biggest of the hit. So funny enough, hopping over to the gold chart, it seems like gold didn't care too much. We did have a big slide on gold today, which I think was a little bit unwarranted considering this is the risk asset we usually throw everything into. I would have expected a lot more of a push today, especially after seeing all this, but instead we just kind of trailed off from the highs we made. And this was the trade that I just broke down in a previous video, and I guess we got out at the perfect time considering what is going on today with everything right now. Gold wasn't exactly reacting to earnings or AI hype, it was just reacting to the monetary policy from what I can kind of see. The Fed cut rates, yields are lower, dollar softer, but while stocks were kind of reassessing valuations, gold is just doing what gold does best in this environment. So if we zoom out here on the Nasdaq, you can see this entire week kind of in one sentence. Everything was kind of being priced in. We were looking pretty bullish throughout the week, as you can see right here, just a very steady uptrend right here. And then obviously we came into Friday session and just dumped right here. We did have a big slump on Thursday Asia session. I believe this was kind of following the FOMC hype right there. And then we had this massive fall off before obviously reclaiming some of that and then dumping again today with reasoning, that is. The Fed cuts supported markets earlier in the week, but AI stocks like Broadcom and Oracle forced a bit of a reality check, which triggered this massive sell-off, and gold kind of just stayed supportive on lower rates. That's really it. There's no mystery here. There's no manipulation. It's just different assets reacting to different drivers. And this is why I always say, if you look at the chart, markets feel random. But when you understand what the market is reacting to, the moves start making sense. And like I said, this is why I'm such a big believer in framing trades with my macro bias. Your structure can be perfect. Your levels could be very clean. But if you don't understand what the market is reacting to, you are just trading blind. Especially in a trade like this, macro gives you the context. It tells you why something is moving, not just that it is moving. When you stay up to date with what's going on in the world, rate decisions, earnings reactions, and sector rotations, it helps you choose the right direction, avoid forcing trades, and managing your positions with more confidence. You can hold your winners instead of panicking with every pullback, especially if I was sitting in a trade like this where we're continuously ranging for almost half a month before having that final push to the upside. Structure gives you your entries, and your macro gives you your conviction. But when you combine the two, trading stops feeling random and starts feeling very controlled. I hope you guys enjoyed this video. If you found value in this, make sure to leave a like, comment, subscribe. If you want to see me talk about anything else, specifically while we're kind of dealing with December price action and going into the new year, shoot me a comment and I'll be happy to make a breakdown on whatever you guys would like to see. And with that, we'll see you guys in the next one.